Hello guys, welcome back to my YouTube channel. This time we will discuss about interest rates explain, nominal, real, effective. So here we go, let's see the video. What are the different interest rates? The term interest rate is one of the most commonly used phrases in a fixed income investment life cycle. The different types of interest rates, including real, nominal, effective, and annual, are distinguished by key economic factors that can help individuals become smarter consumers and shrewder investors. Nominal interest rate. The nominal interest rate is the state interest rate of a bond or loans, which signifies the actual monetary price borrowers by lenders to use their money. If the nominal rate on a loan is 5%, borrowers can expect to pay 5 of interest for every 100 loans to them. This is often referred to as the coupon rate because it was traditionally stamped on the coupons reduced by bondholders. Real interest rates. The real interest rates is unique because unlike the nominal rate, it factors inflation into the equation to give investors a more accurate measure of their buying power after they redeem their position. If an annually compounding bond yields a 6% nominal yield and the inflation rate is 4%, then the real rate of interest is actually only 2%. Special consideration is possible for real interest rates to be in negative territory if the inflation rate exceeds the nominal rate of an investment. For example, a bond with a 3% nominal rate will have a real interest rate of 1% if the inflation rate is 4%. A comparison of real and nominal interest rates can be calculated using this equation. Several economic stipulations can be derived from this formula, which lenders, borrowers, and investors may utilize to cultivate more informed financial decisions. Typically, when the inflation rates are negative or deflationary, real rates and nominal rates, but the opposite is true when inflation rates are positive. One theory believes the inflation rate moves in tandem with nominal interest rates over time, meaning that real interest rates become stable over long-term periods. Therefore, investors with longer time horizons might be able to more accurately assess their investment returns on an inflation-adjusted basis. Effective interest rates. Investors and borrowers should also be aware of the effective interest rates, which takes the concept of compounding into account. For example, if a bond pays 6% annually and compounds semi-annually, an investor who pays it, this bond will receive 13 of interest payment after the first 6 months, of interest after the next 6 months, and total, this investor receive for the years. In this scenario, while the nominal rate is 6%, the effective rate is 6.09%. Mathematically speaking, the difference between the nominal and effective rates increase with the number of compounding periods within a specific time period. Application. The differences between nominal, real, and effective rates are important when it comes to loans. For example, a loan with frequent compounding periods will be more expensive than one that compounds annually, which is a vital consideration when shopping for mortgage. Furthermore, a bond that pays just a 1% real interest rate may not adequately grow an investor asset over time. Simply, but interest rate effectively reveal the true return that will be posed by a fixed income investment and the true just of borrowing for individuals or businesses. Tips and other alternative. Investors who seek protection from inflation in the fixed incomes arena may elect to consider Treasury Inflation Protect Securities or TIEPIs, which pay interest rates that are indexed to inflation. mutual funds investing in bonds, mortgages, and senior secured loans that pay floating interest rates also practically adjust current rates. The bottom line, when it comes to IB bonds interest rates, strip investors know to look beyond nominal or coupon rates when considering their overall investment objective. I believe a financial advisor can help investors navigate interest rates that keep up with inflation.